Hi everyone. Now that we have a good understanding of each of the core financial statements and the mechanics of how they are interlinked, we will go over a few ratios, metrics, and trends and analyze their significance. We will first cover the terms, their purposes, and their formulas. Then we'll go over an example using Libra Incorporated so you can calculate these ratios on your own and interpret their meanings. We'll first start off with key metrics, and as you can see, we've covered most of these in our core statement lessons, but this lesson will allow us to dive deeper into their significance. Most of these terms will be a review. The only one that's new is NOPAT, and that is net operating profit after tax. And it is calculated by taking EBIT times 1 minus tax. So this term right here. EBIT, as we covered, is earnings before interest and taxes and reflects a company's operating cash flow after partially taking into account of a company's capital spending as depreciation and amortization is taken into account. It is also thought of as a proxy for free cash flow, since, as we mentioned previously, depreciation can be used as a representation for capital expenditures. EBITDA, or earnings before interest, taxes, depreciation, and amortization, shows cash flows from operations before the effect of depreciation and amortization. So that's EBITDA right here. NOPAT provides a clearer view of operating efficiency and the state of a company's core operations after tax, as it's not clouded by the effects of leverage and one-time expenses. So expenses such as write-downs, impairments are ignored. Free cash flow shows the amount of cash left over for stakeholders after covering operating and capital expenditures. We've covered that term previously. And then net income, or a company's bottom line, indicates the amount of revenue left over after subtracting all expenses, taxes, and costs. Next up are the return ratios, and they represent the company's ability to generate returns to shareholders. They include return on equity, return on assets, and return on invested capital. Return on equity is calculated by taking net income and dividing it by average equity, and it shows how much profit after tax is generated for every $1 of equity. It is an important ratio for stockholders as it represents the amount of profits left over for them after reinvestment and after paying back other stakeholders. It may also provide insight into how a company is using financing from equity to grow the business. If ROE is increasing, it could signify that the company is generating shareholder value. And on the other hand, if it is decreasing, it can mean that the company has been reinvesting capital in unproductive assets. Return on assets, or ROA, is calculated by dividing net income by total average assets. It represents how much net income is generated from a company's assets and measures how asset intensive a company is, and can also be used to compare how efficient management is at utilizing assets within a certain industry. Note that this ratio should not be used to compare across industries, as industries utilize assets very differently. Imagine an automotive company versus a software company. Return on invested capital, or ROIC, is calculated by dividing net operating profit after tax, or NOPAT, by the sum of average equity and average debt. It shows how much after-tax income a company generates for every $1 of debt and equity raised. It is used to measure how much it costs for a company to grow, and if ROIC is over 2%, it could signify that the company creates value, whereas if it's under 2%, generally, the company could be seen as destroying value. Next up are some ratios to measure a company's financial health and payout to stakeholders. There are many types of leverage ratios, but the one that's most common is total debt to EBITDA. This ratio gauges how long a company will take to pay off its debt at its current operating level, and it is commonly used by credit agencies to gauge probability of a company defaulting on its debt. An alteration of this ratio is net debt over EBITDA, so using net debt instead of total debt, which paints a rosier picture, as net debt is usually lower than total debt. Interest coverage ratio is calculated by dividing net interest expense by EBITDA. It measures how easily a company can pay interest on its debt. So as you can imagine, a higher ratio would indicate a stronger company in terms of financial health, and generally a ratio below 1 would indicate poor financial health. Dividend payout ratio is dividends divided by net income and indicates how much of a company's after-tax profits is returned to shareholders. A high dividend payout ratio indicates that a company is reinvesting less money back into its business and paying more of its earnings in the form of dividends. This is more common among mature companies. Conversely, a low dividend payout ratio means that a company is reinvesting more back into the business for growth. This is usually the case for companies in the growth phase. The last set of ratios that we're going to discuss are the balance sheet ratios and are generally used to measure efficiency. Many of these ratios are going to be used to project working capital items on the balance sheet. The asset turnover ratio is calculated by taking revenue and dividing it by total average assets, and it measures how efficient or dependent a company is in using its assets to produce revenue. The next ratio is current ratio, and it is current assets divided by current liabilities. It measures the ability of a company to pay off current liabilities using current assets and is used to measure a company's liquidity. It is also an indicator of financial health. We then have inventory, receivables, and payables turnover ratios, and these are efficiency ratios that are going to be used later on to project out working capital items on a balance sheet. So inventory turnover is calculated by taking COGS, or cost of goods sold, and dividing it by average inventory. A high turnover ratio can indicate reduced storage and holding costs, whereas a low ratio can indicate poor sales, excess inventory, and inefficient inventory management. It also measures how many times a company sells its entire inventory within a year and how efficiently inventory is managed. Receivables turnover is calculated by dividing revenue by average accounts receivables and measures how many times a company is able to collect its entire receivables balance from customers within a year. This can be interpreted as how efficient a company is in collecting revenue. Payables turnover is calculated by taking COGS, cost of goods sold, or OPEX, and dividing it by average accounts payable. Now, you may be wondering why we're using COGS or OPEX, and that's because some companies, take for example, a software company again, those companies do not have necessarily a high cost of goods sold. So in order to make an apples to apples comparison, we will use OPEX instead of COGS, and that's because OPEX would take more so into account of expenses to run a company. So payables turnover ratio measures how many times a company can pay its payables back within a year. A high payables turnover ratio can indicate that the company is prompt in paying back its suppliers and has high creditworthiness. A low ratio can indicate that the company has the clout to demand favorable terms. And when you look at it, Walmart is notorious for stretching its payables, and that doesn't mean that a company is not creditworthy. So now that we're familiar with the terms and their uses, we'll move on to our exercise so that you can calculate them on your own and interpret their meanings. Okay, everyone, welcome back to our Excel exercise. And here again, we're using our company Libra Incorporated. As you can tell, we've added a third year here, and we just added some numbers, so increased revenue, increased COGS, so forth and so on. We're not going to go over all the changes or updates that we made for year 3, as we're focusing this lesson on our ratios and trends. So this area right here on the bottom is empty, and we're going to walk through these items and interpret the trends and their meanings. So we'll first start off with revenue growth. And revenue growth is calculated as year 2's revenue growth, or year 2's revenue divided by year 1's revenue and subtracting it by 1. Since we don't have a year before year 1, we're going to start off with year 2. So year 2 equals 150 divided by 100 minus 1. Okay, and what we're going to do is we're going to just pull out the first column of every line item right here, and then we're going to just copy and paste, or so copy right, so we could fill out all the columns. COGS as a percentage of revenue, we can calculate for year one because we have COGS and revenue for year one. So we'll go up here, COGS divided by our revenue number. Make sure that we make these a negative so that the negatives cancel out and it's a positive figure. OPEX margin is calculated by taking gross profit divided by revenue. OPEX as a percentage of revenue is calculated by taking total SG&A, and that is our OPEX, divided by revenue. And make sure, again, since total SG&A is negative, we add a negative to our equation, and that cancels out the negatives. EBITDA growth, similar to our revenue growth, we don't have your zeros numbers. So we're just going to, we do have your zeros numbers, but we're not going to input it since it's 0. We're just going to use year 2 and take year 2 EBITDA right here, divided by year 1 EBITDA minus 1. EBIT growth. So very similar, we're just going to be taking EBIT divided by the previous year's EBIT and subtract 1. Net income growth, exactly the same. So net income divided by previous year's net income minus 1. Return on equity will be calculated as net income. So we take our net income figure divided by our average equity number. And since we don't have the previous year's equity, we're going to actually just use end of year equity for year 1. So our total shareholder equity right here. However, on year 2, what we're going to have to do, we can't just copy it over since we're not using average. But since we have an average number from year 2, which is the average of year 1 and the year 2's equity number, we can just take net income divided by average. And keep in mind that as you are typing out a function, you just press tab, and that'll get you to the function that is highlighted. So average of year 2 and year 1's shareholders' equity. So this number right here, you can copy to the right because in year 3, we have an average since we have year 2's number as well. Return on assets is calculated by taking net income and dividing it by average total assets. So similar to our return on equity, since year 1 we don't have an average total assets, we are just going to be taking the ending total assets from year 1. So total assets, net income divided by our total assets number right here, 527. And similar to our return on equity, we are going to be taking net income divided by the average now, since we have those numbers, of the total assets between year 1 and year 2. We'll just copy it over to the right. Perfect. We're gonna just, since we are halfway there, we're going to just finish up the rest right here. So we're just going to be copying over our COGS as a percentage of revenue gross margin and OPEX as a percent of revenue over to the right. And we'll also do the same for revenue growth, EBITDA growth, and EBIT growth as well. And also net income growth. Our return on invested capital is going to be Notepad, and we don't actually have Notepad here, so we'll just calculate it on our own, and that is going to be net operating profit after tax. So in this case, our net operating profit is going to be our EBIT number. And that EBIT number is going to be multiplied by 1 minus our tax rate, which is 21. And keep in mind that we're going to be locking in the tax rate. So press F4 to lock it in. And that'll get us our Notepad number. And remember, we are still going to divide our Notepad number by the average equity and average debt. And since we don't have average equity or average debt for year one, we're just going to be taking the ending balance figures. So we're going to be taking the ending shareholders' equity plus ending debt. Okay, so we're going to be now moving on to year two. And because year two, we do have the averages, we're going to be taking our Notepad number, so that is EBIT, times 1 minus the tax rate, 21%, divided by average of our total debt figure, plus the average of our total shareholders' equity figure. Okay. Perfect. We're just going to copy it to the right to get 4.9 and 12.25. Okay, now we'll move on to our leverage ratio, which is debt over EBITDA, and that is calculated by taking just debt. So we'll find our debt figure here, divided by our EBITDA number. And our EBITDA figure is over here. Remember, in real life, we're actually not going to have a EBITDA figure in our income sheet, so we're going to have to calculate that on our own. That's a 3.6 times, so that's an X right there. Income coverage ratio is going to be our EBITDA divided by net interest expense. So our net interest expense right here is 4. Remember, it's going to be a negative number, so we're going to have to add a minus sign here to cancel out the negatives. I'll just copy this over. Dividend payout ratio is going to be dividend issued divided by net income. So as you can see, year one and year two, we didn't have any dividends. But year three, we had $10 in dividends. And make sure that, again, we make this a negative figure so it cancels out the negative answer that we're going to be getting since we have a negative dividends issued figure here. Asset turnover ratio is going to be revenue divided by average total assets. And since we don't have an average total assets, we're just going to be using the ending balance for year one. So total assets right here. That means for year two, we're going to be using revenue and dividing it by the average now. So the average total assets of 539 and 527. There we go. Okay, moving that over as well. Current ratio is going to be current assets divided by current liabilities. So our total current assets divided by our total current liabilities. And then our inventory turnover is calculated by taking COGS and dividing it by average inventory. In this case, it is actually 0 since we don't have any inventory in year 1. So COGS divided by 0. And remember, we have to put in a negative sign to cancel out the negative COGS. And you can see that we're actually going to get an error. So a way around this error is to do equal sign if error, we get this value. If it's not an error, and if it is an error, we're going to put quotations NA. So instead of showing an error, we're going to actually show not available instead. We're actually going to do the same over here. So if error, and our value is going to be our COGS. Remember, that's going to be a negative divided by average inventory. Oh. NA. There we go, 14 times. Perfect. So receivables turnover, we're going to have revenue divided by accounts receivables. It should actually be average accounts receivable, but again, we're going to be using the ending balance since we only have year 1, which means that in year 2, we're going to do revenues divided by average accounts receivables. Copy that over. Payables turnover. We're just going to double check to see that these numbers are not the same, and they are the same. So we're going to do some auditing to see why that's the case. Okay, so 150 divided by 30, 200 divided by average of 60. Okay, so that makes sense. We're going to get 3.3 times each time. Payables turnover is going to be cost of goods sold or OPEX. In this case, we're going to be using cost of goods sold divided by average accounts payable, since we are a manufacturing firm and our products do have a cost, or I guess a cost of manufacturing, that is. So we are going to be taking our COGS figure divided by average accounts payable. We're just going to be using our ending balance for accounts payable. Here we go. And remember, it's going to be a negative to cancel out the negative COGS figure that we have up here. And that gets us to 2.5 times for year 1. Year 2, we're going to be taking COGS, negative figure here, dividing it by our average accounts payable now. And that gets us to 2.8. We're just going to carry this over, so Control R. And here we have our debt to EBITDA. We need to fill this out. These growth numbers are non-existent since we don't have a year prior to year 1. And there we have our completed ratio and trends. And of course, there are a lot more trends and ratios, or a lot more ratios than what we covered here. But this is a good introduction for you to understand and fully interpret a set of financial statements. So what can we learn from this? We can learn that, first of all, we have very high revenue growth. As you can see here in year 3, it's kind of tailored off a little bit. But, 33% is still extremely high. Cost of goods sold, as you can imagine, has been declining every year. And that could be a factor of just the company being able to produce more or actually being able to sell more, so they're able to buy more in bulk and negotiate a better price for the materials. Cost of goods sold declining has an inverse relationship with gross margin increasing, since the less money you spend on cost of goods sold, the more money you have in gross margin. Operating expenses as a percentage of revenue has been declining slightly, even though we've actually been increasing each factor by just a little bit, and that signifies that there is a lot of operating leverage because you're able to produce more, gain more revenue, and not have to scale up OPEX as much as a percentage of revenue. EBITDA growth, as you can see, similar to revenue growth, has been climbing significantly, and that's the same case with EBIT as well. Net income growth is skyrocketing, and that's just a factor of a low base to start from. So we started with a base of 2, and year 2 we have 22, and year 3 we have 49. Return on equity, as you can see, has been increasing as well, since our net income figure has increased dramatically right here. Return on assets has been increasing. Return on invested capital has been increasing. No surprise there. Debt to EBITDA has been decreasing, which is good because we've actually been paying off our debt. So 2 factors in play here. We've been paying off our debt. So year 2 and year 3, we've been paying off $20 each year. And also our EBITDA has been climbing significantly throughout the years. So this demonstrates to a creditor that we are more than capable of being able to cover our debts and pay back whatever we owe. Interest coverage ratio is extremely high, even in year 1, as we're actually not paying that much in interest to start off with. So we're only paying, what is it? $4 in interest. And we've also been paying back our debt throughout the years. So at the end of year 3, we only end up paying $2.8 in interest. So the banks are going to be very happy about our debt to EBITDA and our interest coverage ratio, which means that we're able to borrow more or negotiate for better terms. Our dividend payout ratio, as you can see, has been 0 since we've been growing as a company. It's a small startup company that we've been growing, and we've actually just inserted a dividend payment of $10 in year 3 just to show you how the dividend payout ratio would look like. But in real life, if you're having revenue growth of 33%, EBIT growth of 106%, EBITDA growth of 63%, you're not going to be spending money in paying back shareholders, as the shareholders will probably like it. Would probably prefer that the money is reinvested back in the business to be able to generate those ridiculous growth figures that we've seen here. But nonetheless, $10 in year 3 is paid back to the shareholders, and that is actually a dividend payout ratio of 20%. Asset turnover ratio is climbing as well, which can be attributed as the company being more efficient with its assets. So generally what that means is with the same amount of assets, and you can see we haven't really increased assets by all that much, maybe just $10 a year in additional equipment, but we've been able to generate a substantially more in revenue. So we're more efficient with our asset usage. Current ratio So our liquidity has actually been coming down a little bit, but it's still more than enough to be able to cover any kind of liquidity issues. Inventory turnover indicates that we're able to sell our entire inventory 14 times throughout a year and 8 times throughout a year in year 3. And as you can see, receivables turnover and payables turnover has remained relatively steady throughout the years, which doesn't really signify anything other than that the company Libra has remained relatively steady and consistent in how they are paying back their suppliers and also collecting revenue.